Opendoor closed out the week at $7.15, finishing Friday's session down about 5.5%. It wasn't the ending many investors hoped for, especially after the strength we saw on Thursday. But even with today's pullback, the stock managed to hold above that important psychological and technical level of $7. And that, in a week like this one, matters more than the red number on the screen. Because what we're really seeing right now is a stock caught between short-term volatility and longer-term macro forces that haven't yet played out. And for Opendoor, those forces may end up being supportive rather than destructive. When you look closely at Friday's session, nothing about the move lower suggests panic or structural weakness. There was no company news, no filings, no executive commentary, and no negative headlines that triggered the drop. The selling looked like a combination of market-wide softness, profit-taking after Thursday's rally, and algorithmic pressure tied to macro sentiment. In other words, the typical noise you expect when markets are uneasy and investors are waiting for clarity. But what's far more important than the red candle is the fact that Opendoor once again defended the $7 region. That level has been tested multiple times over the past 2 weeks. Each time the stock approaches it, buyers step in. Each time it dips underneath for a moment, the price is pulled back up. And each time it closes above $7, the market reinforces the idea that this level represents real demand. Stocks do not defend a level repeatedly unless someone is willing to accumulate there. And accumulation at a floor is often the foundation for the next leg up when the right catalyst arrives. And speaking of catalysts, the interesting thing about Opendoor right now is that the next set of meaningful catalysts aren't company-specific at all. They are macro-driven. They're tied to mortgage rates, housing demand, consumer confidence, and the Federal Reserve. And right now, all signs point toward a macro environment that could become more favorable for Opendoor heading into December and early next year. One of the biggest headlines this week came from the mortgage market. The average 30-year fixed mortgage rate fell back down to around 6.19%, its lowest level in weeks. When mortgage rates fall, affordability improves, demand cools off less aggressively, and housing activity begins to shift. For a business like Opendoor, which relies on transaction volume and the ability to price inventory accurately, lower rates are oxygen. They create movement in a market that has felt frozen. They encourage buyers who are sitting on the sidelines to start browsing again. And they relieve some of the pressure on sellers who have been struggling with the affordability mismatch in the current environment. At the same time, expectations continue to grow for a rate cut by the Federal Reserve at their upcoming December 9th and 10th meeting. Economists are now projecting a 25 basis point cut, a move that could further lower borrowing costs and ease financial conditions. For most companies, rate cuts simply mean cheaper capital. But for Opendoor, the effect is more direct. Housing is one of the most rate-sensitive sectors of the economy. When rates go down, activity goes up. When activity goes up, Opendoor has more opportunities to buy and sell homes, to turn inventory, to generate fees, and to stabilize margins. And even though none of this has shown up in the numbers yet, the positioning ahead of a potential rate adjustment is meaningful. This is why Friday's red session shouldn't overshadow the bigger picture. The stock didn't fall because something broke. It didn't fall because sentiment turned against the company. It simply reacted to a choppy market at the end of a week filled with anticipation, uncertainty, and shifting expectations around interest rates. That's how high beta names behave in the absence of new information. And it's why holding above support is such an important sign of ongoing strength beneath the surface. Another part of today's story is the psychology of investors watching Opendoor. Many people reacted strongly to Thursday's upward move, and just as many felt discouraged by today's pullback. But this is where perspective matters. Stocks don't move in straight lines. Momentum builds in small waves. And in the case of Opendoor, the stock has now spent several sessions stabilizing above $7 despite meaningful volatility in the broader market. This stabilization is often what happens before a larger directional move. It doesn't guarantee a breakout, but it does suggest that the market is still undecided, still consolidating, and still preparing for the next phase. The warrant dividend distribution earlier in the month also continues to play a role in the background. Investors now see their K, A, and Z warrants reflected in their brokerage accounts. That process created some confusion and repositioning, but now that the dust has settled, the effect has largely normalized. In some ways, the warrants give investors more confidence to hold common shares through volatility. In others, they give traders optionality. But what they haven't done is cause chaotic sell-offs or destabilize the share price. If anything, The stock has shown more resilience since the distribution, not less. There's also the broader narrative around Opendoor's positioning for 2025 and beyond. The company remains focused on operational efficiency, technology-driven home assessments, and improvements to its pricing models. Leadership has been vocal about accountability and alignment. And while the recent quarters have shown both progress and challenges, the strategy appears consistent and deliberate. None of that changes because of a 5% move on a Friday afternoon. Ultimately, the most compelling takeaway from today is that the stock remains intact. It remains supported. It remains in structure. And it remains heavily influenced by macro factors that are about to come into clearer focus. This weekend and early next week will bring more data, more commentary, and more signals from the macro environment. Those signals will matter far more than today's pullback. So the real question heading into next week is simple. Can Opendoor maintain its hold above $7 long enough for the macro catalysts to kick in? If rates continue to fall, if the Federal Reserve delivers a cut, if housing demand picks up even slightly, and if investor sentiment stabilizes, Opendoor could quickly find itself back on the front foot. The stock has already shown that it can push into the mid-sevens and even flirt with $8 when conditions align. That range remains achievable. But the stock needs the right macro fuel. This is where patience becomes important. For long-term holders, the short-term noise doesn't erase the structural opportunity the company is pursuing. For short-term traders, the volatility creates opportunity, but it also requires discipline. And for observers trying to understand where Opendoor fits in the broader housing technology landscape, the next 2 weeks may offer some of the clearest signals we've seen in months. As of right now, the setup is this: Opendoor defended its floor. It held its structure. It absorbed a volatile week. And it enters the weekend with a stronger macro backdrop than it had a month ago. That doesn't promise a rally. But it does create a foundation for one if the right catalysts appear. So while today's close wasn't pretty, the story remains intact. And as the next few days unfold, investors will be watching mortgage rates, housing data, and Federal Reserve decisions closely. Those events will shape the path ahead for Opendoor. And if the company gets even a modest tailwind from the macro environment, the stock may be better positioned than many realize. The takeaway is simple. Red days happen. But Opendoor is still holding its line. And sometimes, holding your line is the most important thing a stock can do before the next move begins.